Hey guys, Steve again here with Frost Protection Group, and I hope you're enjoying these videos and maybe learning something from them and can use them either now or in the future to protect your family or protect somebody else's family with life insurance. Anyhow, today we're going to go over the mortgage protection scenario again. Now, the other day I mentioned to you about when you buy a house or refinance a house, you're going to get inundated with all these mailers that are come out, and they're going to have you fill out a form, you mail it back in, and then you're going to start getting calls from life insurance agents like myself. So my gift to you or whatever is to for you, instead of sending those back in, just call me. I've been doing this for 15 years, and more than likely, if you do send it back in, you'll get an agent that probably works with me that's going to be calling you, along with it, 5 or 6 other ones. So you know, if you don't want to get all those calls, if you want to know who's calling you, give me a call or shoot me a text or whatever it is. Anyhow, this is how life insurance works for mortgage protection. And you don't have to have just bought the house or refinanced the house. You could have had this house for, let's say, 10 years. So let's say you have a $200,000 house with a 30-year mortgage, and you've had it for 10 years. So if you were going to sell the house, you would probably only owe about 2/3 of that initial mortgage, right? Somewhere around maybe 130, 140,000. So if somebody were to pass away at that point, is the other spouse or lender or person on the mortgage, are they going to be able to afford to make that house payment by themselves? Usually not. I mean, there's a lot of times that, you know, one person makes a lot more money than the other. Maybe there's not a whole lot of life insurance or anything that's going to offset the price of the house. So having that life insurance set up is going to keep you from having to do a GoFundMe or from losing the house. Now, it's not so much that you're going to not be able to afford the house and maybe lose the house, but guess what? In this scenario, you've got $60,000-$70,000 of equity in the home. So if you let the house go to somebody for what you owe, or the bank takes it from you, guess what? You just lost $60,000, maybe 70. So we don't want to see that happen ever. So getting the life insurance set up is a great plan. So let's say you're young. Let's say you're from 20 to 50. And there are term life insurance policies out there that if you're healthy, you have a decent driving record, you can get coverage up to usually $300,000. And it's good for 30 years. At the end of 30 years, that policy goes away. Now, there are some that have what they call return of premium options, so you can get that option, and at the end of that 30-year term, you can get every penny you paid in back. So let's think about this. You just took out an insurance policy for 30 years. At the end of the 30 years, you get all your money back. That's a great option. Now, they also offer, some of them offer you a paid up life insurance policy at that point. So you don't pay any more money, but you still keep a life insurance policy that's usually good till you're about 100 years old. So great deal. Doesn't mean you have to go for the return of premium. Let's say you've got a 30-year mortgage, and you know the first 15 years you're going to owe the most on that home, right? So maybe you take out a 10 or 15-year term, and at the end of that 10 or 15 years, the insurance goes away. But now, if somebody passes away, you know you've still got, you know, a lot of equity built up in the house, and you're only leaving a debt of about half the amount of money. So that's an option. But then a lot of times we like to get maybe a whole life or permanent policy, universal life, or something that's going to last forever. So let's say you had a $100,000 term, and maybe you got a $25,000 or $30,000 universal life. Once that term ends, you still got the universal life. So if somebody were to pass away, there's money left over in the life insurance to make the mortgage payment for a few years, and that gives your family time to think, wow, what do we sell the home? Do we refinance to get the equity out of the house? What do we do? So having this life insurance set up is a great plan. especially if you own a home and if you have children, you're going to maybe leave homeless. Anyhow, if you're older, if you're my age, let's say, or in your 50s or 60s or whatever, and you have this home, now maybe you can't afford a term, or maybe a term just doesn't make any sense because you can only get a 10 or 15, maybe a 20-year term, and you've got this 30-year mortgage. So let's take out enough money in something permanent, like the universal life for a whole life, for maybe 2 or 3 years worth of mortgage payments. So when and if you do pass away, and we all are eventually, right? So when you do pass away, you're leaving money for your family that they can make the mortgage payments for 2 or 3 years, maybe only a year, whatever it is, whatever you can afford. And at the end of that period, at least they get enough time to think about what their options are. Should they sell the house? Should they downsize? Should they, keep it, refinance, whatever it is. So you're eliminating the risk of them losing the mortgage, losing the home, and losing the equity in the property. So, like I said, if you got a house, you don't have this coverage set up, I don't care if you just got the house or you've had it for 10 or 15, 20 years, get a hold of me. I've got a Calendly link above this, and you can get on there, schedule an appointment. We can talk for a few minutes and see what we have that's going to benefit you and your family. Talk to you soon. Thanks.